Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of this advanced nuclear platform.
Yeah, let's do it.
When we approach Oklo, I think the first thing we have to just accept is that we're not looking at a normal power company.
Okay.
Not even a current cash flow business. We're really looking at a pure infrastructure technology platform.
A pre-revenue developer, basically.
Exactly. A pre-revenue advanced nuclear developer that's promising to solve, well, some of the world's biggest power problems.
And that's the hook, isn't it?
Yeah.
It's not just about energy. It's about, a potential answer for the insane power demand coming from things like AI.
Right.
But if they're not making any commercial revenue yet, how do we even evaluate them? What are the near-term financials telling us?
Well, they're deep in their R&D and deployment investment phase.
Which is exactly where they should be.
It is. And that priority, you see it right on the balance sheet. For Q3 2025, their earnings showed that heavy spend. They had a net loss that actually missed the analyst consensus.
Oh, really? By how much?
They reported negative 20 cents per share, and consensus was a little better at negative 13 cents.
So missing consensus isn't necessarily a red flag here. It's more just a sign of them spending heavily on the future.
I think that's the right way to look at it. They're burning cash now to build this massive asset base later.
And just how big is that ambition? What's the story management is selling?
The ambition is, well, it's staggering, frankly. It's the whole reason for the long-term investment idea.
Well,
Management is guiding toward, get this, over $21 billion in annual revenue by 2038.
$21 billion. Wow.
And that's not from, selling power to homes. It's built on deploying a huge fleet of their own modular reactors and locking in these high-margin, long-term contracts.
The power purchase agreements, or PPAs.
The PPAs. Primarily with big industrial clients.
Okay, $21 billion from a standing start in 13 years.
Yes.
It's an astronomical goal.
Yeah.
So we have to ask, how are they paying for all this R&D, especially with nuclear projects being so slow and expensive?
This is where their financial setup gives them a really crucial bit of stability. They have a very strong balance sheet right now.
Okay.
After their recent capital raises, they're sitting on about $1.2 billion in cash.
That's a good cushion.
It is. And crucially, they're effectively unlevered, no debt. They're relying almost entirely on equity and federal support.
That's a huge de-risking factor.
Yeah.
That unlevered status means if regulatory timelines slip, which, let's be honest, they often do in nuclear,
Right.
they aren't facing an insolvency crisis. But heavy reliance on equity, that brings up the big scary word, dilution.
You've hit on the #1 reason for the recent pressure on the stock price.
Absolutely. The fear of, substantial ongoing dilution is very real. They set up a large $1.5 billion at-the-market equity program, an ATM.
Can you just break down what an ATM means in practical terms for anyone who doesn't follow these things every day?
Sure. Think of it like a big flexible credit line. But instead of borrowing cash, they can sell shares into the open market when they need to.
So not all at once.
No, in smaller chunks, strategically. It's perfect for these kinds of long lead time, capital-intensive projects. It ensures they always have a cash runway for years, which is great for the project itself. But it creates a steady supply of new shares hitting the market, and that, without a doubt, puts pressure on the stock price in the short term.
So the trade-off is clear. They're buying safety and funding for their projects, but the price is immediate friction for shareholders.
That's the deal. Which brings us back to the technology. What justifies all this? The optimism, the cash, if they're diluting shareholders and still posting losses, what's the competitive moat?
The moat is all about their differentiated, patented tech. It's designed to solve two problems at once: generating power and dealing with nuclear waste.
Okay, how so?
Oklo is developing a revolutionary plutonium-fueled fast reactor, and that is the key difference between them and their peers in the SMR, or small modular reactor, space.
Right, because most SMRs use that more conventional light water technology.
They do, and this plutonium-fueled fast reactor design, it just changes the entire fuel cycle game.
So what does that mean exactly?
It's designed to use surplus legacy nuclear material plutonium as what they call a bridge fuel.
So they're taking something that is currently a hazardous waste problem.
A problem that requires incredibly expensive long-term storage, yes.
And they're turning it into clean power.
Exactly. They are efficiently converting it. The big strategic advantage is that this process reduces the volume and long-term toxicity of that waste stream way more efficiently than a standard reactor. They're basically recycling material others see as a liability.
That sounds incredibly valuable, both for the environment and, strategy. But nuclear development is political. What validation do they have that this tech is even viable?
The federal alignment is exceptionally strong, and that takes a lot of the risk off the table.
Okay.
They were selected for the DOE's, the Department of Energy's reactor pilot program. That's a huge endorsement. And they're advancing multiple programs with U.S. national labs, like the famous Los Alamos National Laboratory.
LANL. Okay, so what's the biggest technical milestone to come out of those collaborations recently?
That would be the completion of the multi-day plutonium fast spectrum critical test suite.
That sounds complicated.
It is, but what it gave them was modern, highly specific benchmark data for these kinds of systems. It's essentially proprietary design data.
And in a secretive industry like this, having your own federally validated data.
It creates a design advantage that very few, if any, competitors can claim. It shortens their design timeline, and it makes their case to regulators much, much stronger.
And that data feeds into their main reactor design, the Pluto reactor. So let's bring this back to the customers. They're not just selling to the grid. They're specifically targeting high-value clients, AI data centers. Why is that focus so critical?
It's all about margin and reliability. I mean, AI data centers are the fastest growing power users on the planet.
And their needs are very specific.
Extremely. They need huge amounts of power that is base load. That's 247, 365, no interruptions, and it has to be clean.
Traditional renewables like solar and wind can't really do that without massive battery backup.
Right. And the grid often isn't big enough or it's too slow to scale. Oklo's whole model is to build these small modular reactors faster and closer to where the demand actually is.
Offering reliable, clean power that a big centralized coal plant just can't match.
Exactly. And because they are solving this mission-critical problem, literally powering the AI backbone, the economics allow for a premium. That's how they get to that $21 billion revenue target. They aren't selling a commodity. They're selling reliable, custom infrastructure.
Okay, let's switch gears to market volatility. Because the story sounds great, but the stock chart has been pretty wild.
Very wild. We saw a massive run-up, a rally of about 300% earlier in 2025.
Driven by that AI power hype.
For sure. But that kind of parabolic move was, of course, followed by some really sharp drawdowns. We saw days with drops of 5, even 9%.
So what's happening there?
It's a classic consolidation. You have the momentum players selling out. You have fear about that dilution program we talked about. And then it gets fueled by, high-profile sell calls on TV.
Does that kind of volatility mean the smart money, the institutional investors, are getting out?
You'd think so, but actually the opposite seems to be true. Institutional ownership is still extremely high, around 85%.
Wow, 85%. For a company like this, that's huge.
It is. It shows there's persistent, long-only sponsorship from sophisticated players. The recent weakness looks more like short-term positioning and the market just, digesting that huge ATM program.
Not a fundamental rejection of the technology.
It doesn't look like it. It looks like they're buying into this volatility.
But, the story has been complicated by all these reports of insider selling.
Mm-hmm.
It's hard not to see founders taking money off the table as a bad sign.
And it is a major factor in the negative sentiment. There has been substantial insider selling reported, over $51 million last quarter. You can't just ignore that number.
No, you can't.
Yeah.
So what's the counter argument? How do you defend founders selling $51 million worth of stock?
The bullish case is that this is simply liquidity. These are founders and early holders who just saw the stock have a massive run-up.
Right.
The key point is that even after these sales, the insiders still hold very large stakes.
Mm-hmm.
So the argument is that it's transactional, for diversification, not a negative signal about the company's future.
But it's something you, as the investor, have to weigh. The strong balance sheet versus the optics of founders selling.
Absolutely.
Okay, so stepping back. We've hit the dilution risk. What are the other major structural hurdles to them hitting that $21 billion goal?
Mm-hmm.
What are the biggest execution risks?
The biggest risk is probably market timing, especially tied to that AI build-out.
Mm-hmm.
The whole sector kind of took a hit after we saw reports of delays in some big AI infrastructure projects, like ones tied to Oracle and OpenAI. The risk is that the demand for this kind of power, it just shows up later than the market is pricing in right now.
And then there's the big one, the regulatory side. You mentioned they still need NRC approval.
We need to be very clear on this. The NRC, the Nuclear Regulatory Commission, they are the gatekeepers.
And it's a slow process.
It is inherently slow and complex. It can take years. Oklo is still working toward getting that design approval for their Pluto reactor. They don't have the full design certification that some of their peers already have, which means they do carry a higher level of regulatory uncertainty.
That makes the timeline super sensitive. So, for investors watching, what are the key catalysts to look for in the next few months? What could turn this from an R&D story into a real commercial plan?
First, I'd watch the upcoming Q4 earnings window very closely. We need clear updates on their cash runway, how they're planning to spend capital, and, most importantly, some concrete project milestones.
Reassurance that the cash burn is productive.
Precisely. Second, any real progress on the regulatory front will move the stock. Specifically, updates on the Pluto reactor design using that new LAN-L data.
And I've got to imagine the biggest driver wouldn't be a technical update, but a customer win.
Oh, by far. That's the most explosive sentiment mover. The biggest catalyst would be any announcement of, say, a non-binding memorandum of understanding, an MOU, or a framework PPA with a major industrial customer.
Especially an AI data center operator.
That would instantly validate the whole market opportunity and shift the story from R&D expense to a real contracted backlog.
So this is one of those situations where you have to hold two opposite ideas at once. You have huge technological promise, but also huge regulatory and financial uncertainty.
That's it, exactly. When you pull it all together, the investment thesis is that Oklo offers this outsized, asymmetric upside. But it's only for the long-horizon investor who can stomach the volatility. The differentiated technology and the strong federal partnerships give it a solid footing in a market with, deep, multi-decade tailwinds from decarbonization and this explosion in data center power needs.
This kind of story really demands patience. But the chance to build a position in a potential category-defining company during these pullbacks that are often driven by things like capital raises, that's exactly what long-term investors look for. If you're looking at Oklo, you have to remember you are buying a 5 to 10-year growth story.
It's not a quarter-to-quarter earnings play.
Not at all. I think the question you have to ask yourself is, do you believe the future of power for AI is tied to solving the nuclear waste problem at the same time?
That's a great final thought. And if you want to keep up with these evolving stories, make sure you hit subscribe and leave us a comment below. We appreciate your support.